and welcome to the opening panel of Livewire's 2021 Income Series, Solving the Income Puzzle. My name's James Marlay. I'm a co-founder of Livewire Markets, and I'm delighted to be bringing you this session today with the objective of giving you some insight into the backdrop that we find ourselves amongst in 2021, and also drawing on the expertise of my guests to hear about how they're thinking about this environment and how they're going about tackling the challenge of building income portfolios. And I'm delighted to have pulled together a highly credible and very experienced panel of investment experts. We'll introduce them one by one, and then we're going to get into a discussion to cover all the topics that are front of mind for you. My first guest is Charlie Jamieson. He's the Chief Investment Officer of Jamieson Coote Bonds. Jamieson Coote Bonds is an active bond manager with a focus on preserving investor capital. Charlie's had a long career investing in bonds, and prior to starting with Jamieson Coote Bonds, he managed bond portfolios at Merrill Lynch. Charlie, welcome to the show.
Thank you, James.
Scott Haslem is my next guest. He's Chief Investment Officer at Crestone Wealth Management. Scott has held that role since 2018, and prior to that, he served as the Chief Economist Australia at UBS for nearly 2 decades, Scott. So a great mix of wealth management and economics background. Welcome to the show.
Thanks, James.
And my third and final, and most definitely not least guest, is Giselle Roux. Giselle was a Chief Investment Officer at Escala Partners for 6 years, and prior to that at JB Ware. She's now an independent advisor, and she provides her insights and services to a number of financial advice firms. Giselle, great to have you on the call. I always enjoy your direct and candid responses. I know you'll leave no stone unturned. Charlie, I'm going to start it with you. I'm going to kick it off with the backdrop that we're facing at. The market has become obsessed with this idea of inflation and that we're on a path to returning to normal. So what are your views on this front? And is a move to higher rates realistic?
Well, thank you, James. The markets are correct to be obsessed with this inflation piece. It's a critical piece in the puzzle. Obviously, it can drive central bank policy. We know that low interest rates have been very supportive for all risk markets. So they're very correct to be focused on it. And it's obviously causing a lot of debate amongst those that believe inflation is transient. We're more in that camp. To those that believe that we have had a secular shift and we're now moving to a higher inflation regime that's sustainable. And I think, we've made our views on this very public over the year. We wrote a big white paper on it earlier in the year, which we published on Livewire. And the net result of that was inflation would rise materially as a result of the base effect, and then would start falling away, as we've already seen. But it can be just problematic enough to make central bankers do something about it. And that's where it gets really interesting, given that we're still under these very highly accommodative settings, real emergency settings to save economies and markets and societies from what they faced in March and April of last year. And yet, despite the fact that a lot of the world has reopened, and now, thank goodness, Australia is listed to reopen in the coming weeks and months, we'll move through the worst parts of the health crisis. Vaccination rates have lifted. Economies will recover. Are those settings still appropriate? And how difficult is it to extract yourself from those settings? So we've seen central bankers been unable to do that with great force since the financial crisis more than a decade ago. So, we think that inflation's critical. We do believe that we will ultimately get back to a low-inflation environment. As much as all of this base effect has now come and gone, a lot of the things that pushed inflation much higher, things like used cars and airfares and lodging away from home, is already starting to turn down quite considerably. But underneath that, there is this supply disruption inflation, which is occurring. And so I do think it'll be longer time until we get back to kind of trend. The problem with transient is nobody defines, how long that actually is. Do my kids have a transient problem not doing their homework because they're exhausted from home, online learning? We're all drinking too much. Do we have a transient drinking problem in lockdown? What is transient? With inflation, no one's really defined it. And clearly we know that we're going to have higher periods of inflation because of this supply disruption. We saw exactly that after the GFC, where we had these much higher inflation outcomes as a result of bottlenecks. We've had all kinds of bottlenecks, whether that's been containers in the wrong places in the world, Suez Canal blockages, rolling, lockdowns, reopenings, all of these things. And of course, insatiable demand from some parts of the consumption space for folks that are lucky enough to have retained most of their income, through these lockdown periods. And are desperate to get out and spend and consume. So I don't think that the markets can ultimately live under materially higher rates happily. Certainly, we haven't seen politicians or central bankers want to put up a framework that would be more supportive of that type of policy evolution. I do think that we are in a low rate environment, not to say that we can't have our periods of sell-off. The bond market's already been very volatile over the course of this year, but I don't believe that we're going to 3, 4, 5% in interest rate settings anytime soon, because the debt loads are simply too high, and the demand destruction that would occur in the economy as a result of that would mean that we just can't have a escape velocity moment. So that's not to say we won't have a small period of normalization of policy, but the terminal rate, how far we can really get before we might come back down to lower rates, is very, very low after everything that we've been through.
Interesting. Scott, you've got a long background in economics, which no doubt you draw on when you're putting your thinking cap on with asset allocation and building portfolios at Crestone. What's your view from an economics background on this inflation question, and then maybe transition into how you're starting to think about reflecting those views in your portfolios?
Sure. Well, I think in terms of the near term, I think I've got a very similar view in the sense that I think it is transient. I think we all knew what was causing inflation. It was base effects from a year ago, bottlenecks, everyone coming out of their homes at the same time and trying to do the same thing. So, look, I think the inflation was transient. We're seeing already now that the monthly data in the US is coming in well below what it was through April, May, and June. So I would be in that same transient camp. I think inflation will moderate, and probably moderate more than people think, into the first half of next year. I'm probably a little less sanguine on a 2 to 3 year view. I'm sort of worried a little bit potentially that there's going to be too much liquidity chasing too few goods and services on a long-term view. But it's not a view that would drive me to have super high inflation, but I could see a scenario where inflation sort of settles in at 2.5 to 3 rather than sort of 1.5 to 2. And I think that would have a material impact on markets, portfolio design, and how you would think about inflation. And picking up something that sort of was said earlier from Charlie, just this notion that everyone wants inflation. Central banks want to hit their inflation targets. They've got institutional issues. I mean, Phil Lowe's sitting there, subject to some review from the OECD potentially, or the government, because they haven't hit their inflation target. Every government needs a bit of inflation to get themselves out of their debt. So, if you're saying there's no inflation coming, you're kind of betting against every policymaker who seems to want inflation at some point over the next 2 or 3 years. So I'm a little less sanguine about inflation on a multi-year view. And I guess in the way you think about reflecting that, it's obviously not an issue for the next 12 months, but eventually you start thinking about long duration assets and how you position your fixed income. Obviously, fixed income managers can still make money in a rising yield environment, but potentially bond yields underperform equities. If you are going to see interest rates trending higher over time, and again, as Charlie said, central banks will eventually want to do something about the inflation that they've tried to generate themselves. And then, of course, within equity markets, obviously longer duration sectors could struggle a little bit. So we're thinking about those type of issues and how we find inflation protection maybe in unlisted spaces in our portfolios.
Giselle, as I mentioned in my introduction, this is a topic that the market has become obsessed about ever since we got an inflationary spike or an impulse at the start of the year. When you're speaking with a number of the financial advice firms that draw on your services and they ask you how to think about this, what's your response?
To add to Charlie, won't repeat what Charlie and Scott, because by and large I agree. One thing I think that is of interest to me is that we're seeing a lot more inflation in goods and service markets rather than income. In other words, wages are, certainly in Australia, not going anywhere very fast, whereas what people are paying for goods and services is going to increase. And you can think about the increasing cost of healthcare services, a whole variety of goods markets. So people need to be very mindful that what income they have or what wages they see may not cover some of the cost increases that are there. I mean, housing is a very obvious one where, house to income ratios have gone ballistic. So I think there's more to the inflation argument than just the rates. As I said, I don't disagree with Charlie and Scott's comment on rates, but the actual impact on investors and households and behaviour may well be quite different to what we've experienced in recent past.
And Charlie, just I guess a question for you. One of the things that we talked about when we were framing this discussion was around considering the full, range of possibilities as well as probabilities. People have constantly been surprised by what the backdrop has been, and here we sit with 0.1% as the official rate here in Australia. And when I type that out, it still feels like I've made a mistake. So I guess, I'm surprised at how low rates have gone in Australia. As you mentioned, we're in emergency settings, yet things are bubbling along okay. We got here. What's to say that we couldn't experience negative rates like we've seen in overseas markets, particularly in Europe?
Look, absolutely nothing, James. I mean, the hardest part of my job at marketing over the last few years is taking people to that uncomfortable place where they hadn't naturally been before. But having come from European markets and US markets and spent a lot of time watching Japanese markets, it was fairly obvious to us from a long way back that we were going to go to very low rates. It wasn't that Australia would be, excluded from what was happening in those powerful global forces. And of course, we still can. Now, obviously, it's much easier for people to formulate a pathway to higher rates and better risk-free returns. But sadly, if we do run into the wrong set of economic outcomes, then rates can be lower and could be negative. I mean, we've had plenty of Australian government securities that have traded negative. As much as we haven't had an official negative cash rate setting, we've seen some very short-dated bonds and bills at times trade slightly negative. So I don't think that it's a one-sided distribution with regard to where rates go. I fully do expect that we will see tapering from central banks, and people often expect that automatically means we'll go to higher rates. I think absolutely on the day it's announced that will be the case. But if you look at other periods of tapering through the other iterations of quantitative easing, ironically, bond yields have actually fallen when the central bank steps out of providing that lubrication for the economy. People get concerned and risk assets have tended to struggle. It hasn't always been as straightforward as you would think. Clearly, we're tapering because we're in better times and calmer waters, but it's not as obvious as people might suggest. So I don't believe that we'll see particularly long-dated rates moving materially higher. I do think if we get tapering, we can have a change in the term structure of the curve, and that starts to get quite technical. Some bonds will do better than others. Shorter dated bonds might not do as well. But we absolutely can see more stimulus and potentially more QE. No doubt you're going to ask, I know later on, about some outlooks that concern us. We have this enormous fiscal cliff coming up in the United States next year. And we may very well see more stimulus if the economy slows down as a result of that. So the asset class, implications, I think clearly if we do get higher rates, Scott touched on those longer duration equity markets, something that people need to think through carefully. All of these, cap rates that people have been using, and certainly in the property markets, we've seen some transactions on tremendously low, yields. If we were to get higher, longer dated yields, that would all be under sufferance, I would assume, fairly quickly. And it's been a wonderful bull market. Everybody enjoys a market that grinds and performs slowly. As we know, markets can be hyper fragile at times, and when they do decide they want to reprice, we've seen them do that very violently. We've seen it in bond markets earlier this year. We saw it in equities and credit last year. We saw it in all markets in Q4 of 2018. And so I think that, in these, very electronic algorithmic markets where risk clusters are really tightly held, who's short equities right now? Who's short credit? If something changes in the wind and we got higher rates or unexpected policy tightening from central banks more than markets were expecting, could get a bit ugly quickly, because there isn't just that natural balance that would keep things on a stable platform, and we'd see some pretty substantial volatilities, I've got no doubt.
In terms of return expectations, I'm going to move on from some of that backdrop. I think how aggressively people are invested obviously has a big implication for if we do get a sell-off or volatility. Scott, 5 to 6% was the number or the range that a lot of the retirees and people thinking about income quoted as their requirement or target return. What's your view on setting a number like that, given where the risk-free rate sits right now? What sort of numbers do you talk about with clients?
Well, it's a great question. And I think I've spent most of my first 3.5 years at Crestone talking to prospects and clients around having to lower their return expectations, given that the risk-free rate's around 1%. A lot of investors struggle to align their true risk profile with their return expectations of 10%, but no volatility. So I think it's a difficult world when term deposits are 0.3 and people want really high returns. If you look at the capital market assumptions, those sort of long-term 3 to 5 year type return expectations, can you get 5 to 6%? Absolutely, on a 3 to 5 year view. The way we design portfolios is a balanced portfolio more than 5%, a growth portfolio close to 6%. But coming back to some of the points that sort of Charlie made, we're in an environment where we haven't had a pullback in the US S&P of more than 5% for over 200 days. I mean, there's going to be volatility. If interest rates do start to rise, if they rise quickly, which is not my expectation, but obviously if bond yields start moving quickly, that's going to create some volatility. So I think you should be targeting 5 to 6% benchmark returns over 3 to 5 years, and you should be able to pick some managers that outperform and make some tactical decisions that can add some value along the way. But will you definitely get 5 to 6% in every year? No, I'm not sure you will. I think we're going to see some pullbacks and some periods of volatility that are going to challenge investors' expectations.
Scott, in terms of diversifying portfolios, one of the things that came through in our investor survey was an increasing prevalence of asset classes like private debt, private credit, private equity. People looking at alternatives in the bond market, high yielding bonds. What are some of the pros and cons of people needing to add these lesser known asset classes, particularly for some of the investors that we might be talking to? Some of them are being listed. They've often packaged up nicely with a big headline yield on them. What's your take on stepping into that market?
Thanks, James. Well, yeah, alternatives is a pretty diverse range of assets, and I would argue becoming increasingly diverse and increased opportunities for investors, which I think is a good opportunity. We obviously saw Peter Costello from the Future Fund sort of arguing that the rise of or the need to be in private markets is good for them but bad for mum and dad investors. But there are increasingly number of opportunities that high net worth investors can access in that alternative space. And the main positive is that alternative investments have different risk and return characteristics to your traditional cash bond equities. And so obviously, theoretically and mathematically, adding them to portfolios improves the diversification. And as I think Giselle sort of mentioned, higher returns in those areas. So overall, it can boost the return of the portfolio, improve the risk and return characteristics of the portfolio. But there's definitely some things to watch out for. And I think the main thing is alternatives can be a little bit more complex. And so investors should really know what the underlying investment that they're investing in, what is the alpha that a particular hedge fund is trying to achieve, what sector is the private equity focused on, where are the loans. Those types of issues around what is the underlying investment is very important. I think the other issue is I'm probably not a huge fan of listed alternatives. To me, that's a little bit of an oxymoron. I think one of the key benefits of alternative investments is they aren't exposed to the listed market. They aren't exposed to the whims and fancy of retail flows or market movements. Sometimes the underlying assets are exactly the same and over time will equal out, but you don't have that volatility. So I think the main things to be careful of is that you understand the underlying investment, you're getting the right fee structure, you're, where possible, unlisted. And I guess the other key issue for us is the manager dispersion is massive in the alternative space. So within if you're investing in large cap equities, the difference between your best and worst performing manager might not be that much. In the alternative space, whether you're in private equity or late stage VC, the difference between the best and the worst performing manager can actually be 10% a year. So you've really got to make sure you've got good managers. But there's a lot of advantages in the alternative space around your ability to play themes, climate, all these types of areas. Toll roads, you can get inflation protection in unlisted property where you've got revenue that's inflation index. So there's a lot of advantages in that space. But just watch the underlying investment, pick the right managers, be aware that you might have less liquidity than you would in the traditional market.
Yeah. Giselle, I could see you nodding away furiously down there. I'll bring the same question to you. Just people are being exposed to more of these alternative assets. Could you share some of your views on, I guess, sensible steps to follow, and maybe talk about some of the preferred asset classes under that alternatives banner from your perspective?
To follow on from Scott's comment about risk, the one thing in alternatives is that risk and volatility are not, in alternatives are very different to the way we think of equity volatility is the volatility of the share price, and that's typically what people perceive as risk. Given that alternative assets are not priced in liquid markets, you're not going to see volatility, but you have to understand that there is significant risk in many of these portfolios. So thinking very, very carefully about risk, because in things like private credit, it is the upside is known. It is the return on the investment if all the interest payments are made and the capital is returned. The risk is entirely if that does not occur and you end up with a default, or you don't end up with all your capital back. So these are very different type of risk profiles. And as I said, the risk, the returns may be more obvious to people, but the risks are not. So judging what the risks are, higher, as Scott mentioned, higher returns inevitably mean there is more risk being taken in many of these portfolios. But most importantly, they are not marked to market, so you can't disguise the inherent volatility of those by not marking them to market. And you should not expect liquidity. They all have in small print that they tell you will give your money back, but we can be reasonably confident that if there were to be very problematic times, they would have to gate those because they simply cannot return that money that quickly. So understanding the nature of these investments, as Scott mentioned, it takes quite a bit of work. There isn't the transparency we have with equities. We don't have 20 brokerages and hundreds of fund managers talking about stocks that everybody's familiar with. These are quite unfamiliar to most people, and they need to tread very carefully before just jumping in and picking up on one or two, thinking that those might be the solution to their portfolios. In terms of what people can get, the good thing is that there is a lot of diversity coming into the market. There is a great diversity in the non-traditional credit space, be it in concentrated private lending, to very diverse portfolios, to portfolios that have asset-backed securities, mortgage-backed securities. There's a whole raft of potential investments there, and one would encourage everyone to think about diversifying across the non-traditional fixed income space as a component of their, crossover between fixed income and alternative portfolios. And then there is plenty others. I do think the the sort of venture capital space is a very tricky one for individual investors, but there are some, fairly, well-known private equity with a lot of holdings in them that people can access through more traditional sources. And there's an increasing sort of cover if people are willing to spend time in very non-traditional, anything from carbon trading to agriculture, asset investment, various kinds of investments out there. It's not for the faint-hearted, and people need to understand what it is, but there are actually a lot of other things around that people who are interested and perhaps knowledgeable may be prepared to consider.
Okay, so to finish up, I've got two questions to finish our panel session off today. I'm going to go round the grounds. The first one is I'm going to ask our guests to share a risk, and then we're going to finish on a positive, because we all need to have something bright to look forward to. So first question, Scott, a risk out there that you're seeing either in portfolios or the broader environment that you really think is worth calling out at the moment?
Look, I'll call out one very quickly from both. I think we haven't touched on it today, but obviously there's a lot of geopolitical risk out there, and I think that is a cautionary tone in terms of how you structure portfolios. Obviously, a lot of these things are binomial and they're very hard to pick, but there is quite a lot of geopolitical developments that could create problems for risk appetite in the world, and we should be cognizant of that. I think from a portfolio perspective, the key risk I would note is a lot of people sitting there in large holdings of term deposits that are rolling off from 2 to 3% down to 0.35. It would be a mistake to rotate out of those into just purely risky assets and change the risk structure of your portfolios without really acknowledging that. So I think you've got to be careful that you roll into similar assets, or you're going to have to roll up the risk curve a little bit, but you don't want to put too much risk in your portfolio. Yeah,
interesting. Geopolitical risk and equity market bubble were the two number one fears of the investors in our survey. So it sounds like you've touched on a few of them there. Giselle, question for you. What's the risk in portfolios or the broader environment that you want to call out?
Yeah, my view would be is we need to be quite thoughtful about where the Australian economy will go over the next 2 to 3 years, with the commodity cycle rolling over, the likelihood that our services like education will struggle to rebuild themselves. We've got population growth is almost certainly not going to be what it was in the past, and that was a very, very big driver of economic conditions here. House prices at high levels. I do have some concerns that the Australian economic growth could prove to be quite tricky and suboptimal. Our tax structures are not beneficial. There's a whole host, and there's a lot of resistance to real reforms here, which I think is quite regrettable at this time. So we can see almost the $8 starting to show that risk aversion towards Australia already. And I would encourage people to, their overseas unhedged part of their portfolio is a good buffer always towards poor domestic conditions and should be thoughtfully structured that way.
So that's really about thinking about getting that, not being over, reducing the home bias, I guess, is the summary there.
Yes, to a large extent, but that's also, I think it plays into this. If you're taking on a lot of private credit, just be mindful about your other Australian exposures as well. Don't let it become excessively determined by growth conditions here, because private credit is essentially a growthier version of where you were before.
Charlie, what's the risk that you want to call out?
Look, I agree with both Giselle and Scott. I'd just add that the US fiscal situation is up for material change as we come into 22. That's only 3 months away, really. For those that are watching US politics, the Democrats are doing a pretty good job of infighting at the moment. It's all predicated around this $3.5 trillion stimulus program. Has the political situation been dire enough there to flip around the midterms and we get into a lame duck president situation again, through 22? The contraction that we will go through is from something like 13.5% of GDP in terms of a deficit down to about 4.5 to 5.5. It's the largest fiscal contraction that we've had, larger than World War II. And so we really need the private sector to accelerate materially to fill up that void. And I think that's something that as we come around the turn and markets look around the next corner, they could be looking at, because if that coincides with central bankers that are just taking those baby steps towards tightening policy, you could get a clash of enough negativity that can just unlock that volatility genie a little bit and maybe move markets around a little. So I think that bears thinking through.
And what's the date for my diary on the fiscal cliff, Charlie?
Well, when people start writing about it, I mean, it's a narrative machine. When people start talking about it, it's like inflation this year. It's just come out of nowhere. It's all people want to talk about, and then it'll moderate down and we'll be on to the next thematic. So, in a 24/7 news world, the talking heads on financial media, the strategists will write about it. No doubt Livewire will publish lots of things on the narratives of the day. This is what we do as a marketplace, and we do focus a lot of attention on fairly, sometimes slim, areas of markets or the economy. But I do think that as we get closer to 2022 and that becomes more obvious, if we're seeing global growth momentum, waning from really high levels. Absolute data is still pretty good, but trend is definitely falling away. We're coming into winter in the Northern Hemisphere again, all these kind of things. And all of a sudden, this can just pop up and become a big issue because we've had so much support. It's been so generous, combined with these liquidity solutions. It's been a nirvana-y type environment, and you can see what asset returns have done as a result of that. It's been a great time to be an investor, but it's not looking as bright and shiny as we come around the turn.
Okay. All right. Well, we're going to get off the grim news, and we're going to finish this panel on a positive. Scott, I've asked each of you to come along with a reason to be positive or an opportunity that you've identified. So what's the positive or the opportunity from your camp?
Well, I think the positive, notwithstanding that I believe a bit like Charlie, that we're in a world of shorter cycles and potentially periods of volatility, I think the positive is there's some real big picture macro policy insights that are out there that could guide us for the next few years. And by that, I mean central banks who've underperformed their inflation targets for the last 5 years or so have a massive incentive not to end this cycle prematurely. And their mates at governments also need the cycle to be good to generate tax revenue and have inflation to pay off their debt. And so I think it could take some time for any inflationary problems to build. We saw that through 17 and 18. It took a long time for the Fed to keep going. So I think there's some big policy insights that suggest, notwithstanding bouts of volatility as central banks make baby steps, I think policy is going to be pretty accommodative for quite a period of time. And the other positive, just to finish off on, is that indexes in equity markets are close to useless in terms of sort of really thinking about investing. There's plenty of stocks today that are down 10% over the last 3 months. And so there is value below the indexes, which investors who are looking should be able to find.
Okay, great. Giselle, what have you drummed up for me to put a big smile on our investors' face, the nice positive for us?
Well, I'm increasingly taken by the fact that the corporate sector is miles ahead of government on things like environmental, climate change, pollution controls. And I'm quite optimistic that the corporate sector is going to come up with solutions. It's in their interest to do so. And it generates a whole new sort of cycle of life for the corporate sector to think about doing business differently if they have decided, hand on the heart, to actually try and make a difference to these, I'll call them broadly based environmental. They include social issues, whatever the case might be. And I think there's more and more companies that are actually really committed to it. And I'm not saying it's going to create a profit nirvana, but I think just forcing people to think differently about the way they've done business often creates opportunities that people hadn't imagined before. So I'm optimistic that, ironically, the corporate sector's got something good going for it at the moment, as opposed to always being beaten up as being the bad guys on the street.
Okay, great. Yeah, there's no shortage of evidence that the capital's flowing that way as well, and fund managers thinking about how they want to allocate specifically on those guidelines. So a good one to raise. Charlie, what's your good news for us to finish off the panel session?
Look, the good news is that Northern Hemisphere, which is inoculated and vaccinated, is just moving through COVID. COVID is becoming yesterday's story. For those of you who have friends or family over there, from talking to folks in places like the UK or the US, it's pretty much life as normal. Certainly there are still cases, but they don't seem to be as serious. There are lots of things that are more deadly for you in those places than COVID-19. And that's a great thing. Hopefully, when we do come out of this, whenever that is in weeks or months, depending on where you are right now, we won't go back in and we can start that healing process and move through it. I do think governments and central bankers will be very supportive to not trigger, economic scarring that could occur if they were to tighten too quickly. As much as we'll have these debates about tightening policy, what actually will occur will be very, very minor, and it'll come at a time, so there'll be less government bond buying and support for credit instruments, but it'll also come at a time when there'll be far less supply. As we were talking about before, that deficit goes from huge numbers to much smaller numbers. That's the same here, looking into 22. So in terms of a demand-supply equation, it's not material. So I think that there's lots of reasons to be positive as we roll into summer. We get our freedom back, and 2022 has got a lot more to look forward to from a societal point of view, and hopefully markets will be pretty robust and support mechanisms will be there to maintain that status quo as we come through this incredibly volatile period for humanity. These pandemics, they're once in 100 years, and they're our war, and we've just got to get through it and move to the other side. And I think we're well on the way. So that puts a smile on my face for sure.
Yeah, hear. All righty, folks. Well, listen, that's going to wrap up our opening session. I really think our three panelists have covered a lot of ground and really helped us to think about what the backdrop looks like now and how that might look from a big picture, and also some of the nuances around portfolio construction in this current environment. I'd like to say a big thanks to Giselle, Charlie, and Scott. Thank you all for taking the time to join me on the call today. I really appreciate your views.
Thanks a lot, James.